We are here with Jonathan Hobbs of stopsaving.com, and John is going to bring us an institutional approach and viewpoint to Bitcoin in the crypto space. He's also the author of several books, one of which I just have finished reading. Fantastic book. So John, why don't you tell us about your background a little bit and about the books that you've written?
So my background, I guess I've had two careers in the investment industry over the last 15 years. The first was, a corporate career, and then that's moved into a more entrepreneurial career. So the corporate career began at Morgan Stanley in a very back office entry-level role where I was just learning the ropes of banking operations. From there, I kind of did my rounds. I ended up at a few different investment firms. And then finally, in 2014, I joined a firm called M&G Investments, where I was a valuations analyst. And my job there was to kind of assign valuation models to some of the more difficult investments that M&G held, difficult to price investments. And I'm sure someone in real estate, you probably have an idea of what that's about. But I guess while I was at M&G, I started becoming a lot more interested in my own personal financial situation and investment portfolio. So I joined a few investment clubs, and from there, I learned a lot more about investing on a personal level. And then I also finished studying for the CFA, got my CFA charter, and then I started writing a book on investing in mutual funds called Stop Saving, Start Investing. In 2017, I published the book on Amazon and self-published, and then to my surprise, it actually ended up doing quite well. It sold a lot of copies in the UK specifically. So that was the pivot for me, which really kind of just made me decide to go entrepreneurial. And then that's involved a number of things. So I've got, as you said, an investment education website called stopsaving.com, where I talk about a lot of different investment related topics all the time. Also wrote and published 2 books, as you said. And then I've worked with some business partners after writing my first book in crypto, and we started a long-short quantitative crypto hedge fund based in London. I then became chief investment officer of that fund, and then after that, chief operating officer. I've since resigned from the fund. The fund's still going around, but I prefer to trade my own capital. It's easier that way, but also I'm focusing more on content creation and investing, and independently consulting to institutions on, I guess, smaller institutions that want to get involved in Bitcoin and crypto. It's obviously a lot harder for them to do that. So that's kind of my area. So that's me.
Yeah, that's fascinating. I love it. Investment banking, hedge fund manager turned entrepreneur, and you are putting out some great content. That's one of the ways that I found you. I was doing some research on the hash ribbon buy indicator, and your blog has a lot of really great information breaking down different indicators, a lot of information on Bitcoin, and then your latest book that I'm working through right now, I think is really good for people, digital assets, investing in cryptocurrency. And I love the introduction where you talk about waking up in the middle of the night and looking at that Bitcoin price and learning a lesson you'll never forget.
Yeah, that was I was short Bitcoin at the time. It was a very good trade. The only thing is, when I got out, I then switched from Bitcoin into US dollars on that particular trade. So it was a good trade followed by a bad trade. But overall, it was you don't sleep if you're going to look at the charts in the middle of the night.
That's funny. So when did you write your first book on crypto and enter the space?
Yeah. So as I said, in 2017, after I'd written my first book, I started this investment education website called stopsaving.com, and I was looking for content to write about. And this was in about June 2017. And obviously, crypto became quite interesting. A friend from school who I hadn't heard from in about 20 years sent me an email and said, "Hey, I've seen your blog. What do you know about crypto?" And I was very skeptical. But then I looked at the chart and I thought, okay, maybe this could go up. So I started writing content on crypto and researching it. And I noticed that I got a lot more traffic to my website through that. And then I actually put out an investment strategy that I was using and uploaded it, was kind of tracking that on my blog. And that kind of led me to write the book, because I just realized that there's a lot of interest in here. And once I went down the rabbit hole and started learning about Bitcoin and crypto, it was hard to come back. So that's kind of why I wrote the first book on crypto.
Yeah, awesome. Well, today is June 30th. Bitcoin has been making a lot of moves here lately. So you want to jump into the charts first and just kind of talk about what you're seeing,
Yeah, sure.
and what's going on here with the end of the month and everything?
Okay, let me just share my screen quickly. Share the right one. Okay, can you see the screen with about 8 different charts in it?
Yeah, I see. Yes.
Yeah. Don't worry. That's not what I'm gonna open each of these differently. So, basically, what we're gonna do, I think, because it's month end, as you say, we can use the month end, the monthly charts to tell us a bit more about the long term and what this monthly closure means for us. We can also go into the weekly charts, and I think we should go into the dollar charts too, because that's actually quite important for the overall macro picture. And I'm seeing some things in the dollar chart right now which don't look good for Bitcoin, but again, we'll just have to look through it, and then we can all start on that. The daily chart we can start with first, because I think it's quite important to just see where we are from a daily perspective. And when I'm looking at this daily chart, I'm not really looking at longer term. I'm just looking for what we're going to do in terms of a range. Are we going to drop out of this bottom line? And you can see there's kind of and there's a few points here, but I'll just go through each of them. So you can see that there's this descending triangle or wedge type of pattern. If we've actually tried to close above this once on a daily chart, and we've gotten above it, but that looked like a fake out on June. We then dropped below it, and now we've actually got above it again, and we're retesting it. So for me, I think if we can keep this trend line and start to go up, that would be very good, at least for a move to the top of the range, and then from there we can see. Because right now I'm not entertaining any long-term bullish thoughts, as you'll see when I go in the macro charts or the longer term charts. But just for terms of the range, I think we could definitely get to the top side of the range, and from there we can see where we're going to go. Another thing that's coinciding with this is this yellow line here is the 21-week exponential moving average, and all the exponential moving average is doing is just weighting more recent price action higher than previous price action. So we've also closed just above that. That's quite bullish, at least for now. But now we potentially look like we could lose it. So we really I want to see us keep closing above this, and then we can talk about a potential a higher move, not necessarily a bull market move, but a higher move. The other thing to note is this blue line, which is the 50-day simple moving average. If we get across of this 21 EMA with the 50 simple, that would be quite bullish. And in the past, when that's happened, we've had pretty good moves, not necessarily a bull market, but it just means good moves for further upside continuation. Of course, the caveat to all of this is if we drop below and we start getting back in this range, it's very likely we're going to fall out of the sky. And this trend line, the more times you test it, the less likely it's going to hold. The daily MACD, which is this bottom over here, this is just a momentum indicator, just shows price momentum. We can see that it's actually turned green, and it's still green. So as long as that's green, I'm quite happy. If it starts to go white, as it did over here, you can see we look more likely to go down. If it starts to go red, I'd probably get a bit more worried. So yeah, I think so long as that stays green, we're okay for now. On the RSI, which is the relative strength index, it just measures the relative strength of buyers versus sellers. We can see that we've had this very long downward sloping trend line forming, and we tried to get above it on this fake out over here, which we had, and then we went back down below it. Now we're above it again, and we've actually retested it quite clearly, you can see, and we've bounced above it. So that to me is quite bullish, at least for a move to the upside. So I guess so short to medium term, I'm still bullish until proven otherwise, I guess. And that's probably going into the month of July. But now I guess if we look at the monthly charts, it tells a bit of a different story. So you can still be bullish on the shorter term, but on the longer term, a lot's got to happen for us to get out of this mess. So this here is a chart with essentially monthly chart with Bollinger Bands. And every time we've trended above the Bollinger Bands and then had a full body candle open and close below the Bollinger Bands, we've gone into a bear market, except for this time over here where we had the 2013, 2014 kind of double peak cycle. So 2 out of 3 times is 66%. And you can see that right now, barring an active guard and we actually close at new all-time highs, this is going to be a full body candle, open and close inside the underneath the top Bollinger Band. So on the balance of probability, that's not very bullish to me. The next thing we can do is go to, let's just try. So, yeah, the RSI index, again on the monthly. You can see here that when we've been in bull markets, the monthly RSI has gone into strong overbought territory, and overbought is anything above 70. So the relative strength of buyers has been really high. When it's gone down and crossed back into the normal zone, as in not overbought, as in below 70, we've had bear markets, longer bear markets, 2 out of 3 times. The only time we didn't have it was, again, this 2013, 2014 kind of double peak cycle. So here, again, you can see if we just go by the last 2 major bear markets, we're looking very similar. We've dropped back into it. So that's, again, 2 out of 3 times. I guess from there, we can look at the weekly charts. I'll start with this one. This is very well known in the crypto market, and I talk about this in my book. It's basically just the 21-week exponential moving average. Every time we've been above this and found it as support, we've been in a good bull run, and when we've been dropping below it and seeing it as resistance, we've been in a bear market. The only time, again, was here where we quickly wicked below it, again in the 2014-13 cycle. So right now, what we've actually done, we've dropped below it on the weekly, we've come back up it, and there is the 21 EMA, and we've tested the top. If I just zoom into this, you can actually see it more clearly. But we've tested the top of that. So what now? I mean, we could easily come back above it, but we've got to get above it. It's spot closing candles above it for this thing to turn around, I think. Otherwise, it does look more likely to go into a longer-term bear market, in my opinion. The other thing on the weekly I can look at is probably this. Yeah. So the MACD, we can see here the moving average divergence. We've had every time we've had like higher highs on the MACD, and then subsequently had a pullback on the MACD to red territory, as in to the downside. We've had major bear markets, and we've had one here, we've had one here, and we've had one here. You won't really be able to see it over here because it's smaller because of the fact that it's too far back. But I think it would be it's different over there. But basically, for these bull markets, we've gone up and we've come back down. So that's again signaling that there's a bit more bearish momentum in the market right now, and there's a lot of work that the bulls will have to do to get out of that. The other thing we can look at is the dollar. So the US dollar, it's kind of like when the dollar is doing well, other risk-on assets tend to be doing bad. And we saw that, for example, here in the Corona crash, where the dollar rallied up and we had everything. We had Bitcoin going down, but we also had global assets and all risk-on assets going down. So the yellow line here is the DXY index. And we can see just the inverse correlation of the DXY and Bitcoin. And obviously, Bitcoin's priced in dollars, so you're going to have an inverse correlation. But remember, the dollar index is based on a basket of all different currencies. So when the dollar is going up against these currencies, it's a signal that people are trying to get to safety. So the question obviously is if there's an inverse correlation there, as far as we can see, what's likely to happen to the dollar? So you can see there's a little W bottom pattern here, but if we go into the monthly chart of the dollar, let me just see where that is. No, that's Bitcoin, apologies. Yeah, this one. So the dollar is obviously in a longer term downtrend, But if you look at the DXY index from kind of 1986, it's had this major support, which turned resistance, and now it's turned support again. So that's the first thing. We've actually had this W bottoming pattern over here. And if this kind of moves up, we can, it's very likely that we'll go, not necessarily long-term bullish on the dollar, but we can actually certainly go at least to here, to the previous high, or perhaps trend up towards the resistance over time. And obviously the cycles of the dollar, this would take about 2 years. So you're looking there at a kind of 2-year cycle, which is how long Bitcoin bear markets usually last. And I don't think if the dollar, if that happened, I don't think it'd be good for other assets too. But of course, we can't really tell. The US dollar, there's just one more chart I had actually where we can see a bit more clearly why I'm actually bullish on the dollar, at least in the short term, is here we've had basically the dollar's formed this W bottoming pattern. And you've got 2 lows. You've got the first low and the second low. The first low actually happened outside of the bottom Bollinger Band, and the second low happened inside the bottom Bollinger Band. So if you look at this, they kind of look like they're the same in terms of absolute, as in their height, and you want higher lows effectively for pattern to turn around. But because of the distance from the bottom Bollinger Band, this one's closer in. This is actually a relatively higher low on the dollar. So that is actually, to me, a bit more telling of a potential reversal in the dollar, and it could go up. Obviously, if we break down and get back below that, that thesis changes, because we can't predict it, but that's just the probability.
Right. And I think monetary policy, especially the US, but globally now, is the key to all of that. And the risk on trade, I think, is tapering and coming to an end here, if not by the end of the year, sometime before.
Yeah, possibly. It does. I mean, again, I think the dollar is a very easy way to. There's a lot of information out there, and there's so many things to look at where you can kind of go, well, what's going to happen to the S&P, the Nasdaq, what's going to happen to gold. But I think if you focus on the dollar chart, it's kind of like, show me the chart and I'll tell you the news. The information in the dollar chart right now, although long term it doesn't look like it's turning bullish in any way, it's suggesting that the dollar's got strength right now, which typically, not always, but very often, isn't good for risk on assets.
It's just deleveraging. So I think the Fed sent a clear message 2 weeks ago, start taking profits.
Exactly. And hopefully that happens gradually and not all at once.
I think that was the point.
Well, unless you're a trader and you want to short.
Yeah. I think that was the point, and that's kind of what we're seeing is that the Fed said, "Look, start taking profits. We have to unwind. We're not going to do it today, but I think we're going to continue to see the dollar strengthen here throughout the year. We're going to see a little bit of deleveraging and unwinding in the markets and other risk-on assets, and we're already seeing it in Bitcoin. I think was the first to take the biggest hit due to the deleveraging."
Yeah, definitely. Yeah, I think we'll have to see how it plays out. They kind of got their back. They're up against the wall. They can't carry on doing it forever. So we'll just have to see what happens. Yeah, I tend to agree with you for now.
Yeah. So from an institutional standpoint, I know that the news would indicate in the crypto world that institutions are just jumping over each other to get into crypto, and they're ready to just start buying Bitcoin. And I think there's a little confusion in terms of how much institutional involvement there really is in the space right now, and whether or not they're actually taking custody of Bitcoin, i.e. Grayscale. A lot of people see these investments in Grayscale and the unlocking of Grayscale, and they think that's actual Bitcoin that people are buying and unlocking versus, what that is. So you want to speak to that a little bit?
Yeah, so I think it's institutional adoption of Bitcoin. It has been accelerating this year quite a lot with the price, but it's been very slow before that. And a lot of that's not been because of the lack of understanding from an investment side or lack of demand from clients. So it's more to do with compliance issues and regulation issues and operational risk issues. So if you think about your average institutional portfolio manager or professional trader, they're going to know they're going to probably understand Bitcoin from a macro investment perspective, either as a macro long-term investment or as an asset that they just want to trade, because it's very volatile. So a lot of them will probably hold it on their personal portfolios. But with the fund, there's a lot of other things that they have to do. So it's a lot more difficult. So if you think about your average portfolio manager who wants to get hold of Bitcoin and put it in the fund, or hold it on in whatever investment vehicle they have books, these institutions have investment committees, they have compliance committees, they have risk committees, they have all these different committees that have to sign off on things. And I've attended and been to committees like this before, and any decision takes a lot of time. But putting client money in Bitcoin, obviously that's a much longer conversation, because they want to iron out, they're not just worried about price risk and volatility risk, they're worried about operational risk, custody risk, all different kinds of risks, liquidity risk. So I think that's been the problem. But actually, a lot of the reason why the adoption has increased this year, although it's not going fully strong, but there's a lot more adoption now, at least, particularly amongst your smaller institutions like your hedge funds and family offices, is because during the bear market, the last bear market that we had, a lot of building's gone on, and people always build in a bear market. That's the time to build. And the pipeline for institutional adoption is now being built, that actually it's becoming a lot easier for these institutions to go to their compliance and risk committees and actually say, well, look, we want to get into Bitcoin. And that can be whether they want to hold it spot on their balance sheets, or on their books, or whatever those are, if it's a fund or a treasury, or if they want to trade it or hold it indirectly through different synthetic products. So if they want to hold it spot, a lot of things have actually improved for them. So first of all, custody solutions. You can be the best fund manager in the world, but if you leave client money or Bitcoin on an exchange, and that exchange gets hacked, or if you try to custody it yourself and you lose the private keys, you've got to answer to the client, and your career as a fund manager is over. So you need an independent custodian to safeguard those assets. And now we have that. We have Fidelity, which is a household name, and they've got a very kind of robust system, custody system, where clients they can own spot Bitcoin, they can buy and sell it without actually having to use an exchange. They can do it through Fidelity's cold storage the whole time. So that's really accelerated. But then also you have these more pioneering companies, the smaller companies like Anchorage, Copper, Coiny Finance. They've got some pretty slick technology, and they all work slightly differently, but a lot of them will plug into exchanges. So clients can actually, or institutions can use the exchanges, trade crypto without actually having to take and leave the funds on exchange, because the funds are actually held in the custody of these providers. So there's that. And then there's also, so that's really come a long way. And I think that was a big thing for institutions. So it's been built. The next thing I think, which is very important, is if you're looking for spot crypto, is now they have very high quality and OTC brokerage facilities. So just over the counter. So if you're an institution and you're buying Bitcoin, you're not buying 10 Bitcoins, you're probably buying a lot more. So you don't want to move the price by buying it on an exchange unless you're doing it through very small orders. So they have that now, which has allowed them to solve the liquidity issues. You also, and this is particularly if you're a hedge fund or a family office, which is where most of the investment from institutions is coming from. You need a fund administrator to calculate your net asset values every day or month or whatever, and to do that, if you've got Bitcoin, they need to understand Bitcoin first of all, and then they need to be okay with that. So now fund administrators are starting to get a bit more okay with that, and there are some that actually specialize in it. So that's box has been ticked. The other thing with administrators is that they will process subscriptions to the fund and redemptions back from the fund. So they have to really consider things like anti-money laundering, know your customer, KYC. And now, if Bitcoin's involved in that, they're going to need to use, they're going to need tools that can actually check that out. And cipher trace and chain analysis those exist today, and they can really scan the blockchain, and they're very good at doing AML and that quite quickly. So there's that. I think so in terms of the spot market, it's really evolved, and it now is easier for institutions to get in. It's obviously a lot harder for the more retail institutions that manage retail money and the pension funds, etc. But for the hedge funds and the family offices, which have a broader mandate, and they can do it for sure. But obviously, the easier way, as you've said, is indirect exposure to Bitcoin, where they're not actually going to buy Bitcoin, because there's actually very easy ways they can do it without having to buy and hold it and custody it. They can. We've obviously got CME futures, so they can trade it long and short. That's pretty standard for these guys. It's very familiar to them. They've done it with all different other assets. Then there's the grayscale, which is, again, as you've said, just like a company that owns the Bitcoin. So they're buying shares in the company, and then they're getting corresponding Bitcoin back. The only disadvantage with trusts, those type of vehicles, is that you end up paying a premium for the Bitcoin, and obviously these guys are very well protected, so they're not going to go under anything. But if you were invested in a trust like that and something like that happened, you'd get back less Bitcoin than you put in theory, because on a liquidation event, that's what would happen, although it's obviously very unlikely. In terms of an ETF, that would be ideal. We don't have that yet, but we do have the next best thing, which are exchange traded products. So those, an ETF will actually physically buy and hold Bitcoin itself, and it won't have a premium. So it's actually a really good vehicle for institutions. But an ETP, it won't have a premium, but it's technically classed as a debt security. It uses debt in Bitcoin, and that actually gives it credit risk. But then again, there's many of them in Europe, and there's many of them for other assets besides Bitcoin that have been used effectively for a long time. So we do have the next best thing. Another thing which a lot of people are, I guess is being overlooked, is the institutional lending and borrowing of crypto. And this will go back more to the spot markets. Things like BlockFi, institutions can put up Bitcoin as collateral, and they can borrow against it, or they can lend out their Bitcoin and earn interest, or crypto and earn interest. So that's actually a really exciting area of the market. So yeah, I mean, if we just sum it all up, if we look at the technicals, maybe we go into a bear market now, maybe we don't. It's really hard to predict. But if we go into a bear market, they're not going to stop building out this pipeline. It's going to carry on being built. So it's just tending towards Bitcoin being a regular asset class at the end of the day. And if you're an investor, the volatility will obviously decrease as the more institutions eventually get involved. Which is nice if you're an institution and you just want something safe. But if you're an investor looking for upside, you actually want volatility. You want big bear markets so you can accumulate, because that's where the upside is. Without the volatility, there is no upside, effectively.
Yeah. So back to the grayscale exposure. So what's interesting about that is they had huge demand initially because the price of Bitcoin was higher. So the alpha was greater between the fees and the spot that grayscale owned Bitcoin. But now with the price of Bitcoin, it seems like that spread has decreased. So there seems to be less interest in that fund right now, from what I'm reading.
Yeah, I mean, that makes a lot of sense if you just look at the price. It's just something that can be thrown into the analysis. I mean, I figure if Bitcoin went back above its all-time high, you'd probably see that premium come in again and go up.
Yeah,
I mean, it was very, very high back in the day. I don't remember the year, but it was extremely, extremely high. And Ethereum trust was even higher at one stage. I think it was like 13,000%, something ridiculous.
Yeah. And with the ETPs and ETFs and other funds, I think the early funds are losing appeal, and other products are stepping in. And like you said, that infrastructure is being laid at broad scale right now. So what is, from your perspective, from a hedge fund institutional perspective, what's more appealing now? Is it exposure to the price action, or is it the long-term value of the asset that's the most appealing?
That's a very good question. I think it just depends on what type of institution you are. So if you're a long short hedge fund, all you care about is the volatility. So you'd want to use derivatives and futures. But if you're a kind of VC or a more macro hedge fund, you want to hold positions for a very long time. And if you want to hold positions for a very long time, you want to hold spot and you want to custody it yourself, or not yourself, with a custodian. So you could also then hold grayscale trust products too. So it just depends on the type of institution, really. I don't think it's clear cut.
Yeah,
family offices will probably be holding spot too, I think, but they might have trading arms. I mean, it just depends. They're very secret. The kind of institutions that are holding it right now are actually the type of institutions that are quite secretive. They're hedge funds and stuff. The treasuries, they don't really have to tell everyone. I don't know if they do, but we know that Tesla and Michael Saylor's MicroStrategy are holding it, so they're obviously holding spot.
And I look at them as retail, because you basically have one individual making that decision. So I look at that as more of a retail trade versus a institutional corporate treasury, because they're not typical. Michael Saylor can do what he wants, and he basically has, and he's convinced his board that this is the right move. And, depending on the financials of the company, may not have had a choice. Elon, same thing. Tesla's not profitable without the credits, and he's just a wild card anyway. So Elon can do whatever he wants to do, and then he pays the price later, as we've seen. So he's a lot of fun. But I don't look at those two maneuvers as corporate treasury institutional moves. I don't know if we've seen any others yet, like a GM or Ford or Pepsi or anything like that. Same thing with Jack Dorsey. I mean, he's one individual that can make decisions on behalf of Twitter, on behalf of Square and the other ventures that he's involved in. Obviously Facebook, Mark Zuckerberg can make some decisions. So there's a difference, I think, in those types of institutions. Wouldn't you think?
Yeah, I agree. And I mean, it's depending on a lot of these are tech companies. So the tech companies they've been started earlier. They've got CEOs who started tech companies from scratch recently, and they own a lot of the equity in the company. And like you say, they can pretty much dictate to the board what they want to do. But it's the older companies, the more stable companies. They're all, obviously these are stable companies, but it's the more kind of the older companies that have been around much longer, which have more spread out, diverse equity holdings. They will have a harder time because there's more people that they've got to convince, I guess. Pension funds,
Michael Saylor is he's the biggest YOLO in the space. I mean, he has made the bet of his life and put it all on the line. So he's definitely sink or swim. And Elon, he threw a little bit in, very small fraction of what he's actually worth. So it'll be interesting to see how these play out. Have you heard any long-term views on the price of Bitcoin and any current views in terms of value and entry points?
I mean, I try not to predict the price that far ahead because I think it's impossible, and I'll probably be wrong no matter what kind of thing comes through. I mean, you hear a lot of things. You look at like the stock to flow model, and that's kind of suggesting we've got a lot longer to go, a lot more upside to go. There's a few models like that. I think, you hear these random targets of 500,000 thrown around. You don't see all the research behind them, but you've got to assume they've done their research. Some of the people making it, like Kathy Woods, has quite a high target. But I guess the best way to kind of, how I would think of Bitcoin, if I had to kind of think what's the long-term value for Bitcoin, is if you look at, so Bitcoin and gold, obviously these are two competing assets. They're both finite supply. Well, gold is harder to be finite, but there's a lot of similarities of Bitcoin and gold and what they would serve in your portfolio. Right now, Bitcoin's a lot more of a risk-on asset than gold, but maybe in 5 years' time, Bitcoin becomes more of a safe haven asset because it's got that fixed and finite supply property. So I would kind of say, well, if that's the case, then you could make an argument that Bitcoin would catch up to gold in market cap. and the gold market cap's gone down while the Bitcoin's gone up since I wrote the book. But it's probably what, 12 trillion the gold
Yeah,
right
10,
now.
10,
Bitcoin,
12 trillion, somewhere in that neighborhood.
yeah, and Bitcoin's I think maybe 1.4 or something
Well,
like
Bitcoin's 6 or
billion.
700 billion right now,
Six,
and
700 billion.
the
Sorry,
whole
that's the
crypto
whole
is
market
in the
cap.
1.2 to 1.4,
Yeah,
depending
yeah,
on
yeah.
what day you look at it.
Yeah. So I was talking. Yeah. So the Bitcoin is the 600-700. So basically, you've got a long way up. You've got like a nearly 20x to get to the market cap of gold from here. So that's putting you at a $500,000, potentially $600,000 target. And I think that's one logical way to look at it. It's difficult based on the chart to just assume, from what I can see on the chart, or what anyone can see on the chart, that it's just going to go up to those prices from here. But from a fundamental standpoint, it's much easier to make these longer term predictions. And obviously, that is going to be met with a lot of volatility if that happens.
Yeah, the stock to flow model will.
Yeah,
the stock to flow model will be interesting to see how that plays out. Right now, it's off target, but we're in a correction, so that's to be expected. You have a halving coming up, and if you look at price action on the halvings, it would indicate that we're not done and that there's more of an upside leg. But all of the charts, all of the market sentiment and fundamentals are indicating that we're in a downtrend that's going to be longer lived than those would indicate. And here's the real question. So what happens to Bitcoin in the event that mining is no longer profitable or sustainable? Yeah. How is the network maintained at that point if miners are just done?
That's always been a problem, but I think people will come in and mine in different areas, I think. So you've obviously got the China crackdown on mining, and we can see from the hash ribbons indicator that you were, I think, talking about on your show the other day, how we haven't got that blue bar signal yet, and we need the miners to stop capitulating. And when they capitulate, what's happening is that the hashing power of the Bitcoin network is going down because miners are taking their mining resources elsewhere, and we can see that on the chart. So if the mining went down, then the miners would carry on capitulating, which would actually mean that we would never get that blue bar signal on the hash ribbons indicator, which would actually mean we would probably never go more bullish again. And for that to happen, you've got to have a moving average of mining hash rate cross to the upside, and then you've got to have the price of Bitcoin, the 10-day moving average, simple moving average, cross the 20-day simple moving average on top of that, and that's when you get the blue signal. What's been strange is that we've had 3 fake signals effectively recently. It went green, and then went off again. Green went off again, and now it's gone green. Well, now we're just waiting, I guess. So yeah, I don't think that would be good for Bitcoin, but I also think that there's going to be other companies and countries also that are going to come in and try to take that market share. So you look at El Salvador with their volcanoes, and you can see that there's a lot of energy around there, and some of the other South American countries will, and Miami and Texas, and so the China thing with the mining is a problem, but I do think that'll be picked up elsewhere, and also they're going to have to make it green for institutions to get involved, and I think that's a lot of the reason why we've had this correction is around that story. But it's very easy to make Bitcoin mining green because Bitcoin mining is a game of electricity versus output, and you have all you have to do is find green energy, and then you can make it green. Whereas if you're a gold miner, for example, there's so many other spillovers that come with that. So
yeah, and ESG is a real thing. It's not just Bitcoin. I mean, that is the theme in corporate America across the board. Every company has put ESG compliance officers in place. They're putting programs and process in place. So it's not just Bitcoin that ESG is affecting and the environmental conversation. So did we cover everything that you had that you wanted to talk about today, or did we miss something?
I think we've covered quite a lot. How much time's gone on? Yeah.
I think we've been at it about 40 minutes altogether. And as far as the end of the month, did we cover all the things that are affecting the Bitcoin price right now with the end of the month, things that are going on, anything glaring that we should be looking out for?
Yeah, I mean, I think we could obviously go into a lot more indicators, but I think a lot of indicators, if you go into too many, you get analysis paralysis. So I kind of stick with the ones that I typically use to trade and invest, and those are still telling me that yes, we could have a bounce in the short term, and that'd be great. But we really need to get back above, and I'd say start closing daily candles, weekly candles at least above 50,000 to start looking like this has been a quick detour in a macro bull run. It's definitely possible that we go into a bull run from here, but just based on the charts that I'm looking at right now at this point in time, I don't see the case for that at the moment.
Yeah, and to make it easy, the hash ribbons buy signal, just take a look at that, and you can keep an eye on that. But how affected is that by the recent exodus of China? Is that going to kind of skew that a little bit, maybe in the interim?
Well, I mean, it could be a reason why we've seen this continued capitulation signals coming from it. At the end of the day, if the hashing power goes somewhere else, so if it goes to Texas or the States and South America and other places, then the mining hash rate will eventually pick up again. And when it picks up again, the indicator will still work as it's normally worked. So I don't think it would break the indicator. I just think the hash rate would just keep going down and down and down until it quickly reverses back up, and then you would have a signal. It's just, when does that happen, and what price are we at when that happens?
Yeah, that's the key. Everybody wants to know, where's the bottom. So for everybody watching, I'm going to put Jonathan's website link in the description comments so that you can go to his website. He has a lot of great information on the hash ribbon indicator and all of the other important indicators with Bitcoin. Very thorough research. All your charts that you just shared are on there. Are those on TradingView as well, or just on your website?
Yeah. So I've actually, what we've been over today, I've got a written version of that too, because I actually put out a blog post this morning. So the timing was very good. I did it this morning and put the blog out, so it's all there.
Okay, great. Yeah, we have people from all over the world, so make sure you go to Jonathan's website. The link will be below. Sign up for his blog. Notifications, I get that. Very informative, keeps you up to date with what's going on in the market and what to look for. I really enjoy your approach to the analysis, the charts, and the fundamentals. It's fantastic work.
Thanks very much, Greg. It's been very good to be on the show, and let's do it again sometime.
Yeah, absolutely. Love to have you back, and maybe we'll dig in a little deeper on some of these other things.
Sounds good, eh? Thanks.